We're going to continue our discussion of the financial market environment. And this time, let's first start talking a little bit about the international marketplace. Everybody is certainly aware that the world is a much more globalized place than it used to be. In the euro bond market, again, corporations are typically issuing bonds, but these bonds are denominated in dollars, right? So typically they're going to sell these to investors that are located in the United States because they're denominated in dollars. The foreign bond market, these again are issued by foreign corporations or governments, but these are denominated in the investor's home currency. So these might be sold in the investor's home market. Now that's not the only place. I mean, it is possible for a person in France to buy a bond that's issued by a company in Germany but is denominated in United States dollars. Again, that is more of a choice, an investment question of whether that makes sense or not. But again, some bonds are issued in dollars and some are in home currencies. And certainly there is an international equity market. Now, in general, the domestic market, our domestic market, the United States bond and equity markets, it's the largest market in the world. So we have the greatest number of securities and investors then in the world. So what are the overall goals of capital markets, right? The first thing we want to talk a little bit about is something referred to as a liquid market. Companies have to be aware, right, that investors want to lend money, investors want to increase their wealth, but they also want to be able to change their minds. They may want to sell something once they get it. So the first goal of a capital market is to provide liquidity, to provide a way for investors to sell something that they have. Now, they want to be able to sell it quickly, but they also want to maintain value. They don't want to lose money because they want to sell their security. The other perspective is a pricing perspective, right? The other role is we want an efficient market that's going to allocate funds to the most productive uses. To do this, we need to know something about pricing, right? We want to allocate funds to the most productive uses as a result of competition, right? We need information and we need to make trades. So an efficient market is one that provides information and then also creates the mechanism between supply and demand so that the information about the analysis of that information can then be used to determine values. And we want there to be some confidence in the information and in the process of pricing. Now, there is a new branch, if you will, or a new concept that's evolving in the finance world. It's something that's referred to as behavioral finance. Essentially what this is it is the melting, if you will, of two disciplines. It brings together the concepts, the decision making in finance, and ties that to psychology, right? Behavioral finance is less involved with the theories that have been developed over time and really spend much more time looking at how people analyze information and how they make decisions today. So behavioral finance is a new kind of process, if you will, of trying to identify values and how investors work. The efficient market hypothesis is the idea, the concept of using information. So securities are assumed to be typically in equilibrium, which means whatever price you see is the fair price based on the information that we know. So at any one point in time, all the information that you know is in the price. But what happens when information is given to the public? New information has to be incorporated, has to be gathered, has to be analyzed. We have to make decisions that affect the demand curve of stock, so then that information has to go in quickly. Typically, because stocks are fully and fairly priced, that is, if we assume that the markets are fairly efficient, you shouldn't waste a lot of time trying to find mispriced securities, right? You should try to find stocks that are either over or undervalued. Now, one of the things that I use there is one of the words is it is fairly efficient. It's not perfectly efficient. So we need to have some understanding that there is some opportunity to find information and use that information to choose good stocks and bonds that may not be perfectly priced by the marketplace. Briefly looking at a few regulations that are kind of important, I guess, to making financial decisions. The first is something called the Glass-Steagall Act. The Glass-Steagall Act was created in 1933. It was established by the FDIC. And essentially this act looked at the financial institutions. It prohibited institutions that took deposits from engaging in activities like securities trading and insurance. So essentially it said you had to have three industries essentially. You had to have a banking industry, you had to have an investing industry, and you had to have an insurance industry. This Glass-Steagall Act has been repealed. President Clinton, in his presidency, they repealed this law. So that's what is created for us now. The phrase that I'm sure you've heard many, many times, too big to fail. Because now the big banks of the world are so big, they're so influential. If one fails, it could be catastrophic for the entire industry and the economy and the world, essentially. The Securities Act of 1933 regulates the primary market. It sets the rules about how companies can issue shares. The Securities Exchange Act of 34 regulates the secondary market. Created the Securities Exchange Commission. It creates the rules of disclosure for companies about how they have to disclose information. It also talks a little bit about what inside information is, etc. So the Securities Exchange Act deals with the secondary market. The Act of 33 deals with the primary market. Now the last couple things we want to talk about is a little bit about how companies issue securities. We talk about several ways that they can do that. One way is through something called private placement. I'm sure you've heard of venture capitalists. Typically, these are individuals or companies that invest primarily in companies that obviously need funds, and typically these are very small startup types of companies. So we can have angel investors who are individuals, and really the more typical phrase for a venture capitalist, these are typically businesses and individuals. Now, what really distinguishes the two is the control that they want. Venture capitalists typically want to have a great deal of control of their investment. And angel investors they don't really want to do so much with the business. They want to invest money, they want to earn a return, and then they want to get out. So venture capitalists are kind of like the Shark Tank people. If you notice, all of their offers for money include some kind of payment in the form of equity. When we issue securities, when companies go public, this can happen several ways, right? If a corporation already has shares that are trading, right, then the most likely there is an agreement that says that the current shareholders have the opportunity to buy stock first. This is what's referred to as a preemptive right. So a rights offering is what's issued to current shareholders. Private placement, we're going to find an investor or a group and we're going to issue directly to them. As I mentioned a little bit earlier, it has very restrictive rules for the investor. Primarily, they can't sell the security for at least a year, sometimes longer. And then there's a public offering. This is obviously when it's sold to the general public. So initial public offering is the first public sale of the firm's stock. Typically, they issue a publication that talks about the security, risks management, etc. They refer to something called a red herring. Essentially, this is the prospectus, but it doesn't have all the information in it like pricing, etc. But it's out there to give people ideas about the stock. So we want you to think about buying the stock. We can't tell you how much it's going to cost. Can't tell you exactly how much we're going to share or how much we're going to sell. We want you just to think about this. So a quiet period is where there's this time frame when there's a red herring available to investors and the company really can't say much about the issue, right? They have to be quiet while people are thinking. Investment bankers is an outsourcing arrangement. This group assists the corporation in preparing and issuing shares. Again, they give advice like pricing, the number of shares, the type of security. Underwriting is the process that they actually distribute to the shares to the investor. So let's think about this process. A corporation needs a certain amount of money. So the underwriter needs to get them that money. How do they do that? So underwriting is a risky activity. Basically, if you go to the extreme, if the company needed $500 million, they would give some shares to the underwriter. The underwriter would give them their $500 million, so the company gets their money right off the bat. So the corporation is no longer at risk, but the underwriter has the risk of getting rid of the shares. So they have to get rid of $500 million worth of securities. That could be very risky. They get paid well for this, but it could be very risky. What investor bankers typically do to avoid some of this risk is they diversify that away by spreading it out over other investment bankers in things called selling syndicates or selling groups. So the last thing we want to talk about, just as an example, is a problem, right? So we have a broker, a person instructs their broker to buy 100 shares of Tilray. At this time, the asking price, I'm sorry I got this wrong, for Tilray is $26.35, and the bid price is $26.30. So let's remember, the ask price is the retail price for the investor. The bid price is the wholesale price. So what is the bid-ask spread? In this example, there's 5 cents difference. So this commission, for every share that's sold, the broker is going to make a nickel on the sale. So let's assume you have an E-Trade account, charges $6.95 per trade. What would be the total transaction cost of making the trade? So the formula, you take the number of shares times half of the bid-ask spread plus the commission. So in this case, for 100 shares, it would cost you $9.45 to buy the shares. Now, what happens if you want to sell the shares eventually? Let's assume the bid-ask price is the same. What is the cost? The cost is the same. It's $9.45. So what is the actual cost per share? Divide $9.45 by the 100 shares. It's 0.0945 cents per share. So to make a profit, how much must the stock price go up in order for you to break even? So the break even is going to be the beginning ask price plus 2 times the transactions cost per share. $26.35 plus 2 times the 9.5 cents is $26 and basically 45 cents. So this stock is going to have to increase in price from $26.35 to $26.53. So it's going to have to rise 0.717 cents. Percent. So it's going to have to go up almost 1%, 0.75%, before you would actually make any profit at all. So this is just an example, if you will, of bid-ask pricing and how you make money when you invest in stocks.